Don't forget to like and subscribe.
I think there are three risks: Omicron, inflation, and overextended markets.
The number one risk is a pandemic.
COVID is clearly an issue.
COVID situation and COVID policies.
Pandemic and geopolitical risk.
There are warning signs out there, whether it's inflation, whether it's other political events around the world.
Geopolitics of China, Russia, and Iran.
I think we are in a much more volatile time.
There's likely to be twists and turns and ups and downs.
22 is another year of rebuilding, and it's going to be choppy. It's not just hiring. You've got supply chain issues.
I think the market's responding almost entirely to interest rates.
What is valued at such a level that will come down, that's interest rate sensitive?
I'm not sure the market's ready for 3 interest rate increases next year, and I think that may come as a shock to them.
If, as always has been the case before, Fed efforts to slow inflation lead to recession, I think all of those things are sources of risk for the market.
Driving the surge in billionaires selling stock. So Ben, what's driving the surge in billionaires selling stock?
So we have, what we analyzed was American billionaires and looked at their stock sales, and that's really what's up so much. And we think that it has a lot to do with tax law here in the U.S. and basically, Democrats in the Congress and the White House have been debating all year what they're going to do about taxes, but what they've sort of settled on, we'll see if it actually passes, is a surcharge of 8% on stock. It would affect stock sales. And what maybe could be happening here is a lot of billionaires are trying to get out before that. And they're also looking at valuations and saying this is a good time to sell. The tax law right now doesn't look like it'll go into effect until January 1st, which means they have a few more days, 2 more weeks to do some selling, and we might see some selling from the people who are really going to be affected by these tax changes over the next couple of weeks.
Yeah, in terms of valuations, are these billionaires sending a signal here that their stock is at the peak?
They are. But I was looking at some of these tech billionaires, and a lot of them really started in 2020. Usually, in a typical year, billionaires don't really sell their stock that much, at least in the U.S., because when you sell stock, you pay taxes on it. A lot of billionaires, like Elon Musk, up until recently, had been choosing instead to maybe borrow against your stock, and you don't sell it. But I noticed, middle of last year, we saw a lot of people in the tech industry just started to sell, and they've continued through that time. And I've talked about like the founder of NVIDIA. I think he started over last summer, and you could say that was a time to sell that stock, but actually it's almost tripled since then. So it's possible, obviously, things could keep going up from this point. But I think billionaires are looking at these valuations and saying, okay, the tax bill might be coming, the valuation's pretty steep, maybe I should start unloading some of those shares.
We have seen some other reasons as well, right? Like charitable projects and so forth.
So when you look at somebody like Jeff Bezos or Mark Zuckerberg, a lot of their sales do seem to be driven by Jack Dorsey's another one. They've made commitments, especially last year. There was a lot of focus on philanthropy among billionaires because the billionaires are doing so well and the rest of the world was doing so poorly. So a lot of Jeff Bezos made a $10 billion commitment to fight climate change. Jack Dorsey made a $1 billion pledge with his Square, now Block shares. So a lot of the sales are actually going into charity. That's true.
Supply-demand picture for bonds, and the way it looks is if you should get the selling of bonds, it worsens that supply-demand picture because the way it works is the Treasury borrows and runs a deficit, but it can't produce money, so it has to sell bonds. And when it sells bonds, if there are not enough buyers of those bonds, then the Federal Reserve got to come in and print money and buy those bonds. And the world right now is over invested in US dollar denominated bonds, pension funds on the 60-40 mix, and they have negative real returns. And cash has a lot of negative real returns. So if there was a selling of that and a moving to other assets, stocks, other assets, commodities, other assets, or other places, other currencies, other real estate and the like, that selling worsens the supply-demand picture. And then if there's not enough demand, that means that the central bank has got to come in and print more money. So yes, it's not only the inflation that's in the pipeline or projected in that supply-demand balance, but it's also what it could be if there's a selling of debt instruments.
Side of it here, and Powell has seemed to suggest that we're on our way to whatever that measure of full employment is here. Is there some sense here that the inflation narrative might be a little bit too strong for them to ignore and waiting for that full employment to reach full?
Well, that's why they would like to delay the idea of rate increases, because if they are tapering, they're still adding some stimulus to the economy.
Social Security is set to see too, but with inflation continuing to climb, is it enough? Here to help us discuss the topic is Matthew Rutledge, Research Fellow, Center for Retirement Research at Boston College. Matthew, thank you so much for being here with us. So a 5.9% increase is slated, which on paper is very nice. But it's not really in line with inflation numbers that we're seeing. For example, CPI came in at 6.8%. And for example, we know things like Medicaid is going to go up by 14.5% next year. So I'm wondering, how does this rate get calculated? When did it get calculated? And then do you think this is the biggest adjustment that we see, or do you think there'll be bigger adjustments to come?
Well, this is as you said, this is the biggest adjustment we've seen in quite some time. And I think when I talked to one of your colleagues a couple of months ago, I think we thought that this was going to be this one-time blip, the biggest COLA we'd see for a while, and then we'd see more normal ones the next year. But given the inflation reports we've seen since then, they calculated the COLA from the previous October to this October, and then November came even higher. So is a possibility we would actually see another fairly big COLA adjustment next year. It really depends, I think, on so much of what's going on and so many of the things that we've been looking at in terms of whether this inflation is going to be transitory or not. Are the ports going to still be backed up? Are we still going to be seeing labor shortages? Or are we going to finally kick the pandemic or figure out what the end game should look like? At this point, I would anticipate that the COLA would be more like the 2 or 3% that we usually see than the 6% that we're almost seeing this year. But if we're not able to get inflation back under control, I think we're going to. The good news, I think, is that Social Security beneficiaries are going to be protected against most inflation that they would face.
You know, I saw a pretty alarming stat, Matthew, about seniors and how heavily they rely on those monthly Social Security checks. In some instances, it can make up to at least 50% of a household's income. What does that tell you about the state of retirement savings in this country?
Well, two things. One is that Social Security is essential to protect. Very hard to get away from the importance of Social Security. And so if we get closer to the point at which the trust fund is exhausted and an automatic 20% benefit cut kicks in, then that's going to devastate a lot of household portfolios for the people that are relying on that Social Security benefit. The other is that we should definitely be thinking about alternatives, that more reliance on employer-sponsored retirement savings through 401ks or more saving for people on their own, or easier ways for people to access their home, which is often the biggest assets that any household would have available to them. All things are going to be, basically we need an all of the above approach to make sure that people have all of the resources that they might need in their retirement. And that includes, I think, extending Social Security's generosity, at least as far as it's been. Definitely not cutting back.
Rely on Social Security, but projections show that they may not be able to pay full benefits by 2034. So what about people who are now paying into the system and wondering if they'll see anything that comes out of it? What sort of pressure is there on government and lawmakers to make a change to make sure that it does prolong and it is there for people?
It's funny, you would think there'd be a lot of pressure. You would think that'd be the kind of thing that candidates, especially appealing to the older vote, since older people are more likely to vote in almost all elections, especially the ones that are not just presidential elections. You would think that the number one issue that people would want to talk about, the politicians would want to talk about, is Social Security. We haven't heard a peep through any of the last few election cycles. It's almost like there is bipartisan support, but it's bipartisan support for avoiding the issue entirely. I think what's likely to happen is, if we really were to sort of force some kind of reform, I think we'd see a mix of extending the full retirement age out a little further. Currently, it's in the process of rising to 67. I think we could see that go higher in exchange for taxing a higher portion of higher income earners' earnings. and maybe some sort of change to the cost of living adjustments so that we see a very gradual change in the generosity of benefits. But more likely, I think that we're not going to see any kind of change. The option that's available, and I think is getting a little bit more attention now, is just the idea of kicking the can down the road by borrowing.
Don't forget to like and subscribe.